Question 1. In a property insurance policy, the section that personalizes the policy with information such as the named insured, property address, policy term, and coverage amounts is known as the A. Insuring agreement. B. Conditions. C. Exclusions. D. Declarations. Answer: D. Declarations. The declarations page contains all the specific details that make the policy unique to the individual policyholder. It answers the who, what, when, where, and how much of the insurance contract, including the insured's name, the location of the insured property, the policy period, and the limits of liability. For instance, your auto policy declarations will list your name, your specific vehicle's VIN, and the dollar amounts for your liability and collision coverages. Think of the declarations page as the cover page of the policy that provides a snapshot of all the key personalized information. Question 2. Leaving oily rags in a pile near a water heater in a garage is an example of what type of hazard? A. Moral hazard. B. Morale hazard. C. Physical hazard. D. Legal hazard. Answer: C. Physical hazard. A physical hazard is a tangible condition or characteristic of a property that increases the likelihood of a loss occurring. The oily rags are a concrete, physical item that creates a dangerous situation, significantly increasing the chance of a fire. This is distinct from a moral hazard, which relates to an individual's dishonest tendencies, or a morale hazard, which stems from an attitude of carelessness or indifference to loss. An easy way to identify a physical hazard is to ask if you can see, touch, or feel it. You can physically see the pile of rags, making it a physical hazard. Question 3. After an insured's car is stolen and recovered with significant damage, their insurance company pays for the repairs and then pursues the responsible party, the thief, to recover the payment. This process is known as A. Arbitration. B. Subrogation. C. Indemnification. D. Contribution. Answer: B. Subrogation. Subrogation allows an insurer, after paying a claim, to step into the shoes of their insured and sue the at-fault party to recover the funds. The key concept is the transfer of the right of recovery from the insured to the insurer, preventing the insured from collecting from both their insurer and the person who caused the loss. For example, if your neighbor's faulty wiring causes a fire that damages your house, your insurer pays your claim and then subrogates against your neighbor, or their insurer, to get that money back. Just remember, subrogation follows payment. The insurer pays you first, then goes after the responsible party. Question 4. An unbroken chain of events between a negligent act and the resulting damage or injury is known as A. Absolute liability. B. Proximate cause. C. An intervening cause. D. Contributory negligence. Answer: B. Proximate cause. Proximate cause is the primary event that sets in motion a sequence of events leading to a loss, without which the loss would not have occurred. For a negligent act to be legally actionable, it must be the proximate cause of the damage. For instance, if a driver runs a red light and hits another car, the act of running the light is the proximate cause of the collision and any subsequent injuries. Think of it as the first domino in a chain reaction that directly leads to the final outcome. Question 5. Which of the following is a legal principle that prevents someone from asserting a right they have voluntarily waived? A. Estoppel. B. Adhesion. C. Subrogation. D. Warranty. Answer: A. Estoppel. Estoppel is a legal doctrine that prevents a party from going back on their word or action if another party has reasonably relied on it to their detriment. In insurance, if an agent consistently accepts late payments without penalty, a waiver of the due date, the principle of estoppel may prevent the insurance company from suddenly canceling the policy for a single late payment. Essentially, the insurer is stopped from enforcing a right they previously ignored. A good way to remember this is, estoppel stops a party from changing their story after someone has relied on it. Question 6. A business owner is concerned about liability for injuries to customers that may occur on their premises. Which type of insurance policy would be most appropriate to cover this risk? A. Workers' compensation. B. Commercial property. C. Commercial general liability, CGL. D. Business owner's policy, property section. Answer: C. Commercial general liability, CGL. Commercial general liability insurance is designed to protect a business against claims of bodily injury or property damage to third parties, such as customers, vendors, or visitors. This coverage is crucial for slip-and-fall incidents or other accidents that happen on the business's premises or as a result of its operations. While a workers' compensation policy covers employee injuries, a CGL policy specifically addresses liability to the general public. Always associate CGL with liability to others, not employees or business property. Question 7. A temporary insurance contract that provides proof of coverage until the formal policy is issued is called A. Certificate of insurance. B. Binder. C. Declarations page. D. Specimen policy. Answer: B. Binder. A binder is a temporary agreement that provides evidence of insurance coverage while the full policy is being prepared and issued by the underwriter. It can be either oral or written and includes essential information like the names of the parties, the extent of coverage, and the term of the agreement. For example, when you buy a car from a dealership, the agent can issue a binder on the spot, allowing you to legally drive the car off the lot immediately. Think of a binder as a placeholder for your official policy. Question 8. The principle of restoring an insured to the financial position they were in immediately before a loss is known as A. Indemnity. B. Subrogation. C. Adhesion. D. Utmost good faith. Answer: A. Indemnity. Indemnity is the core principle of insurance, aiming to make the insured whole again financially after a loss, but not to allow them to profit from it. This means the insurance payment should cover the amount lost, returning the insured to their pre-loss financial state. If a fire destroys your $2,000 laptop, an indemnity-based policy would pay you up to $2,000 to replace it, not $5,000 to make a profit. Remember, the goal of insurance is restoration, not enrichment. Question 9. In a personal auto policy, PAP, which part provides coverage for damages to the insured's vehicle resulting from a collision with another vehicle or object? A. Part A, liability coverage. B. Part B, medical payments coverage. C. Part C, uninsured motorists coverage. D. Part D, coverage for damage to your auto. Answer: D. Part D, coverage for damage to your auto. Part D, often called physical damage coverage, is the section of a personal auto policy that pays for direct and accidental loss to your covered auto. This part is typically split into two main coverages: collision, which covers impact with another object or vehicle, and other than collision, or comprehensive, which covers things like theft, hail, and vandalism. So, if you hit a telephone pole, you would file a claim under your Part D collision coverage. Remember, D for damage to your own car. Question 10. The authority that is not expressly granted but is reasonably assumed that an agent has to transact business is known as A. Express authority. B. Implied authority. C. Apparent authority. D. Fiduciary authority. Answer: B. Implied authority. Implied authority is the authority an agent needs to perform the duties of their express authority, even if it isn't written down in their contract. It's considered a logical extension of their stated duties. For example, an agent with express authority to sell insurance policies also has the implied authority to print business cards and flyers to solicit new clients, as these actions are necessary to fulfill their primary role. The key is that the actions are reasonable and necessary to carry out the express duties. Question 11. A statement made on an insurance application that is believed to be true to the best of the applicant's knowledge is called A. Warranty. B. Representation. C. Concealment. D. Misstatement. Answer: B. Representation. A representation is a statement the applicant believes to be true when they apply for insurance. The policy cannot be voided based on a representation unless it is material, false, and intentionally made by the applicant. For example, stating your home has a smoke detector when you believe it does is a representation. If you later find out it was broken, the insurer likely cannot void the policy because you didn't knowingly lie. A warranty, in contrast, must be absolutely true, making representations a less strict standard. Question 12. If a policyholder and an insurance company cannot agree on the amount of a loss, which policy provision allows each party to select a neutral third party and have the two third parties select a fourth, who will then determine the value? A. Arbitration clause. B. Subrogation clause. C. Appraisal clause. D. Other insurance clause. Answer: C. Appraisal clause. The appraisal clause is a condition in property insurance policies that is used to resolve disputes over the value of a loss, not coverage itself. When the insured and insurer disagree on the amount to be paid, both can hire their own appraiser, and these two appraisers select an umpire. An agreement by any two of the three is binding. For instance, if you believe your hail-damaged roof will cost $15,000 to replace but the insurer offers only $10,000, you can invoke the appraisal clause to get a binding determination of the cost. Think of appraisal as settling a disagreement over the price tag of the damage. Question 13. Which of the following describes a situation where a person is held legally responsible for an injury or damage even though they were not negligent? A. Vicarious liability. B. Comparative negligence. C. Contributory negligence. D. Strict liability. Answer: D. Strict liability. Strict liability, also known as absolute liability, imposes legal responsibility for damages or injuries even if the person found strictly liable was not at fault or negligent. This standard is typically applied to activities considered inherently dangerous, such as owning wild animals, using explosives, or manufacturing defective products. For example, if a company's properly stored chemicals leak and contaminate nearby groundwater, the company is held strictly liable for the cleanup and damages regardless of how careful they were. The focus is on the hazardous nature of the activity itself, not on fault. Question 14. An individual or business must have a financial stake in the property or life being insured for an insurance policy to be valid. This concept is called A. Subrogation. B. Indemnity. C. Insurable interest. D. Adhesion. Answer: C. Insurable interest. Insurable interest means that the policyholder must stand to suffer a direct financial loss if the insured property is damaged or destroyed. For property and casualty insurance, this interest must exist at the time of the loss. You have an insurable interest in your own home or car because you would lose money if they were destroyed, but you cannot buy insurance on your neighbor's house because you have no financial stake in it. This principle prevents insurance from being used as a form of gambling. Question 15. The Fair Credit Reporting Act, FCRA, requires that an insurer must A. Provide the insured with a copy of their insurance policy within 30 days. B. Settle all claims within a reasonable time frame. C. Inform an applicant if a consumer report will be used and advise them of their right to information. D. Offer the lowest possible premium to all applicants with good credit. Answer: C. Inform an applicant if a consumer report will be used and advise them of their right to information. The Fair Credit Reporting Act, FCRA, is a federal law that regulates how consumer credit information is collected, used, and shared. When an insurer uses a credit or other consumer report to underwrite a policy or take an adverse action, like charging a higher premium or denying coverage, it must notify the applicant. The applicant then has the right to know what was in the report and to dispute any inaccurate information with the reporting agency. The key purpose is to protect consumers' privacy and ensure the accuracy of their personal financial information. Question 16. The intentional withholding of a known fact by an applicant on an application for insurance is called A. A representation. B. A warranty. C. A waiver. D. Concealment. Answer: D. Concealment. Concealment is the failure to disclose a material fact that a party has a legal duty to reveal. In insurance, if an applicant intentionally hides relevant information that would have caused the insurer to reject the application or charge a higher premium, the insurer may be able to void the policy. For example, not mentioning that you use your personal vehicle for a high-risk delivery business on your auto insurance application would be concealment. It's not just about what you say, but also what you knowingly don't say. Question 17. In a dwelling policy, which form provides basic, named peril coverage for both the structure and personal property? A. DP1, basic form. B. DP2, broad form. C. DP3, special form. D. HO3, special form. Answer: A. DP1, basic form. The DP1, or basic form, is the most limited of the dwelling policies, covering only a specific list of named perils, such as fire, lightning, and internal explosion. Unlike broader forms, it does not automatically include coverage for things like windstorm, hail, or vandalism unless an endorsement is added. Claims under the DP1 are typically settled on an actual cash value basis, not replacement cost. Remember, DP1 is the most bare-bones option, providing only fundamental protections. Question 18. An employer is held legally responsible for the negligent acts of an employee who is acting within the scope of their employment. This is an example of A. Strict liability. B. Vicarious liability. C. Contributory negligence. D. Absolute liability. Answer: B. Vicarious liability. Vicarious liability is a legal doctrine where one party is held responsible for the actions of another, based on their relationship. The most common example is an employer being liable for the torts, wrongful acts, committed by an employee during the course of their work. For instance, if a pizza delivery driver causes an accident while on a delivery, the pizza company, the employer, can be sued for damages in addition to the driver. Think of vicarious liability as being indirectly responsible due to your relationship with the at-fault person. Question 19. A policy modification that is added to an insurance policy to broaden or restrict coverage is known as A. Endorsement. B. Binder. C. Rider. D. Condition. Answer: A. Endorsement. An endorsement, sometimes called a rider in life and health insurance, is a written amendment attached to a policy to change its original terms. It can be used to add, remove, or modify coverage, effectively customizing the standard policy to fit the specific needs of the policyholder. For example, a homeowner might add a scheduled personal property endorsement to their policy to increase coverage for valuable jewelry that would otherwise have limited protection. Just remember, an endorsement endorses a change to the policy. Question 20. Under the standard ISO Homeowners 3 HO3 policy, the dwelling, coverage A, and other structures, coverage B, are insured on what basis? A. Named peril, actual cash value. B. Open peril, actual cash value. C. Named peril, replacement cost. D. Open peril, replacement cost. Answer: D. Open peril, replacement cost. The HO3, or special form, is the most common type of homeowner's policy and provides two different levels of protection for property. The dwelling, coverage A, and other structures, coverage B, are covered on an open peril basis, meaning they are protected against all direct physical losses except those specifically excluded in the policy. Personal property, coverage C, however, is covered on a named peril basis, meaning it's only protected against the specific perils listed in the policy. Remember that the HO3 gives broader, open peril coverage to the building itself. Question 21. Which type of loss valuation method pays the cost to repair or replace damaged property with material of like kind and quality, without any deduction for depreciation? A. Actual cash value. B. Stated value. C. Replacement cost. D. Market value. Answer: C. Replacement cost. Replacement cost valuation is designed to cover the full cost of replacing damaged property with new property of similar type and quality at today's prices, without subtracting for depreciation. This is in contrast to actual cash value, ACV, which is calculated as replacement cost minus depreciation. For example, if a 5-year-old roof is destroyed, a replacement cost policy would pay for a brand new roof, while an ACV policy would pay for a new roof minus 5 years of wear and tear. Replacement cost provides a higher level of protection by not penalizing the insured for the age of their property. Question 22. Which of the following is a mandatory part of a policy contract that outlines the responsibilities and obligations of both the insured and the insurer? A. Declarations. B. Insuring agreement. C. Conditions. D. Exclusions. Answer: C. Conditions. The conditions section of an insurance policy sets forth the rules of conduct, duties, and obligations that both the insured and the insurer must follow for the policy to be enforceable. These include the insured's duties after a loss, like providing prompt notice and protecting the property from further damage, and the insurer's obligations for handling claims. Failing to comply with these conditions can result in a claim being denied. Think of the conditions section as the rulebook for the policy. Question 23. A driver is injured by a hit-and-run motorist. Which part of the driver's personal auto policy would cover their bodily injuries? A. Part A, liability coverage. B. Part B, medical payments coverage. C. Part C, uninsured motorists coverage. D. Part D, coverage for damage to your auto. Answer: C. Part C, uninsured motorists coverage. Uninsured motorists, coverage, found in Part C, is designed to pay for bodily injuries, and in some states, property damage, that an insured suffers in an accident caused by an at-fault driver who has no liability insurance or is a hit-and-run driver. Because the at-fault driver in a hit-and-run cannot be identified, they are considered uninsured for the purpose of this coverage. This protection steps in to fill the gap left by the irresponsible driver. While medical payments, Part B, also covers injuries, specifically addresses situations involving an uninsured or hit-and-run driver and can cover a broader range of damages like pain and suffering. Question 24. Which of the following types of insurance is designed to cover an employer's liability for their employees' work-related injuries or illnesses? A. Commercial general liability. B. Professional liability. C. Workers' compensation. D. Employment practices liability. Answer: C. Workers' compensation. Workers' compensation insurance is a no-fault system that provides benefits to employees who suffer job-related injuries or diseases, covering medical expenses, lost wages, and rehabilitation costs. In exchange for these guaranteed benefits, employees generally give up their right to sue their employer for negligence. This coverage is a statutory requirement for most employers and protects both the employee by providing swift benefits and the employer by shielding them from costly lawsuits. Remember, workers' comp is specifically for on-the-job injuries to employees. Question 25. The amount of a loss that the insured must pay out of pocket before the insurance company begins to pay is known as the A. Premium, B. Coinsurance penalty, C. Deductible, D. Limit of liability. Answer: C. Deductible. A deductible is a form of risk sharing where the insured agrees to absorb a specific dollar amount of any loss before the insurer's payment obligation begins. By having a deductible, insurers reduce the number of small claims and help keep premiums more affordable. For example, if you have a $1,000 deductible on your auto collision coverage and you have a covered accident that causes $5,000 in damage, you would pay the first $1,000 and your insurer would pay the remaining $4,000. A simple tip is to remember that you deduct that amount from the total claim payment.